Hey everyone, Rob B here with Rob D, and you are listening to the Property Podcast. This week we bring you news on rent controls, a mega mortgage market update, and Rob D talks about his weight.
Welcome to the Property Podcast. Thank you for joining us for the show where we take some time out from advising a multi-million pound property fund, which you can learn about at portfolio.co.uk, and putting together hundreds of transactions every year for our clients at Property Hub Invest. And we bring you some of the knowledge we've gained along the way for free. The podcast, of course, is a spectacular way of keeping up with what's going on in the property market, but so is signing up for our free weekly newsletter, Property Pulse, if you want to get all the week's big stories in your inbox every Friday in an email that you can comfortably read in under 5 minutes. Make sure you sign up at propertyhub.net/pulse.
So it's time for our news story of the week now, and we are bringing you a scary headline. The headline reads, rent-controlled legislation to be unveiled next autumn. Rob, rent controls, that sounds scary. So what is happening? And most importantly, where is it happening?
Clever headline writer. I was done the same thing. They haven't put the words in Scotland at the end, which makes it immediately sound less scary to anyone not in Scotland. But if you are an investor in Scotland, well, you've already got rent control, basically, haven't you? Because they've got this temporary rent cap thing. But they are committed, apparently now, to introducing full rent controls by 2025. And so they're going to be introducing the legislation this year. So I think, Rob, obviously, if you're not invested in Scotland, then it's not immediately relevant to you. But there is going to be an experiment happening on our doorstep. Their opponents, of which I would say are in the majority, point to lots of examples at other times and in other places in the world where they haven't worked. We're going to have an experiment very soon. So we will see if rent controls do, in fact, solve the housing crisis.
Even if it works, Rob, which I'm sceptical of it working, but even if it works, it doesn't necessarily mean it will happen in England, because Scotland has a much better system of buying a home than England. Long-time listeners will know that we've often talked about the Scottish system of buying a home and talked about how much more efficient it was than the process in England and Wales. And yet we've seen that go on for many, many years on our doorstep. And not one of our governments have been tempted to do anything. Now, they are slightly different things, but Scotland has proved a better way of doing things in property, and nothing has happened. So we will see. What I expect to see, though, is that if England and Wales don't adopt anything and Scotland carry on with this for the medium to long term, then that trend we've already started to see of more Scottish investors investing over the border in England and Wales continuing. It makes sense. So our Scottish listeners always like it when we talk about what's happening in their market, but maybe they won't be so annoyed when we talk about England and Wales more often in the future because they'll be investing here. We'll see.
Just before we get to our main topic this week, a quick thank you. I talked last week about my forthcoming book, The Price of Money, which is coming out on the 30th of March, and how if you pre-order the hardback, then you get an invite to the Wealth Sessions, which is a series of online events I'm putting together with celebrated economists, best-selling authors, and all sorts of amazing people. All the information is at priceofmoney.co.uk. But the point is, since I mentioned it last week, not only have lots of people gone out and pre-ordered the hardback, which is awesome, but I had lots of lovely messages from people as well, wishing me luck in sneaking it into the Sunday Times bestseller list. And based on what's happened over the last week, in with a shot.
And what an incredible thing that would be. I would love it, Rob, love it if you made the bestsellers list. I mean, it's a great book and whatever happens, happens. But I think as we come up to 10 years in the Property Podcast, that would be the best birthday gift for you and me, because lots of people mistake me for you and vice versa, so I could pretend I've got a Sunday Times bestseller book as well. So I'm really behind this, so let's help Rob D.
Yeah, it's a win for both of us, just as I'm delighted about Liverpool's result the other day. So, but yeah, it would be a great birthday present. But also, Rob, coming up to our 10th anniversary, there's something else pretty special coming up, and we'll be talking about that next week.
Yeah, we've got an incredible run of episodes coming up at the moment, and starting next Thursday. I mean, today's is special as well, because we've got a guest on the show, but next week we kick off an incredible run of podcasts. We're really trying to up our game and bringing you exciting stuff as we hit the 10-year mark. So make sure your alarms are set for 7 a.m. when the podcast goes live next Thursday, as we bring you a super special episode.
If there's one hot topic in property over the last year or so, it has been mortgages, which makes a change because it was tax for years, but now it's mortgages. Interest rates and mortgages have dominated the headlines and dominated the conversation among investors as well. And for a good reason. They're such a powerful tool for investment that we believe you really should be using them. You're missing a trick if you're not. And yet, so much has changed over the last few months. And as we've been reporting, so much is changing week to week at the moment. So it's something that we like to update you on in our market updates. It's something that we watch very closely. But we don't know even a fraction as much on the subject as our guest today, Kelly Rule from Serious Property Finance. She's been on the podcast multiple times before, and we keep on begging her to come back because she's got such a wealth of knowledge about mortgages, and that knowledge is needed now more than ever. So Kelly, welcome back to the show. Something we've been talking about a lot over recent weeks is that we're seeing rates for various products starting to come down. So you're obviously much closer to the market than we are. Are you seeing the same thing?
Yes, mainly on 5-year fixed products though. We're seeing lenders reduce rates weekly, if not daily at the moment, and it tends to work like a domino effect. Once one goes, the rest tend to follow. Some 2-year fixed products are reducing slightly, but most of these have stabilised now over the last couple of months, and we haven't seen much movement on those product ranges.
From our observations, interest rates seem to be coming down right across the board in residential, buy-to-let in a personal name, and limited company. Is that correct?
Yeah, you're absolutely right. It's completely across the board, which is fantastic news for anyone who's trying to secure a mortgage at the moment. The only products that are going up are variable rates in line with the base rate rises.
So the big question is, do you foresee rates dropping even more? Or are we starting to see the point where they're going to settle for the medium to long term?
Great question. And nobody actually knows the answer to this. The general consensus is that there are further reductions to be had, possibly 1 or 2. In my opinion, the base rate is likely to peak at around 5% and then stabilise around the 4 to 5% mark. And I think this will happen towards the mid to end of this year.
Interesting. Okay. And what kind of rates should investors be looking for right now?
In the main, our clients tend to purchase in a limited company name due to tax savings that can be had. And on this type of transaction, the best rate at the moment is circa 5% on a 5-year fixed. However, we are seeing a handful of lenders crank up their arrangement fees at the moment to anything from 3 to even 5%. Now, the main reason for this is to help more deals achieve a 75% loan to value, as the stress test is more favourable with a higher arrangement fee as the rate tends to be lower. Fear not though. I know these arrangement fees are high, but they can be added to the loan, which most investors tend to do, although you will accrue interest on this basis.
Okay, so for anyone buying now and assuming they can find something close to the rates you've mentioned, generally speaking, do you think they should be looking to fix for 2 years or 5 years?
It all depends on your own personal strategy. Rewind a few weeks ago. One half of my clients were opting for either a variable or a 2-year fixed rate so they could ride the market until it stabilizes. Then they can refinance onto a new lower product when their deal comes to an end over the next couple of years, and then potentially capital raise on the refinance at the same time. The other half of my clients invest for long-term capital growth. They tend to have busy day jobs and are seeking a more hands-off investment. These investors tend to opt for a 5-year fixed rate, knowing that they don't have to worry about refinancing again for another 5 years. However, now that 5-year fixes are continuing to reduce, more clients are now opting for the 5-year option because the deals suddenly work again.
So for any investors looking to refinance, would you fix for 2 years, 5 years, or possibly wait a little longer to see if there are better options available?
Again, all depends on how hands-on you want to be. Refinancing can be a laborious task, especially if you're a portfolio landlord with multiple properties, although using a good broker can take a lot of that admin away from you.
Yes, it certainly can be laborious. What about people looking to pull equity out during a refinance? That's a strategy that a lot of investors obviously follow, but do you have any thoughts either for or against doing that right now?
In my opinion, there's no time like the present. Assuming investors are looking to keep on reinvesting in new properties, that is. If you're refinancing and you can pull out funds penalty free, then my advice is to do this. Otherwise, it could be another 2 or 5 years even before you get that opportunity again.
We're on a mission to open up the benefits of property investment to as many people as possible. And we're doing it with our mobile app, Portfolio. Portfolio provides what we believe is a completely new way to access the potential benefits of property investment, while feeling just as involved as if you owned a buy-to-let. You can find out more about investing through Portfolio at portfolio.co.uk.
We've seen reports in the media that it's a busy market right now. Are you seeing the same? Are there a lot of mortgage applications currently being processed, or are people still waiting patiently?
People were waiting patiently throughout last year, and this was mainly because rates were so high that deals weren't stacking up and investors couldn't afford to be tied in when their return was barely making them a profit. Majority had decided it was best to stick on the standard variable rates with their existing lenders, which were now circa 8 to 9%, and wait with bated breath for the rates to come back down again. Everyone then took a break for Christmas and seemed that the common New Year's resolution was to invest in property or readdress your refinances, as they can't afford to wait any longer. January was literally a whirlwind for me, as there were so many deals to work, but great to see that the market is affluent again, and long may it continue.
So we've talked a lot about rates, which I think is right, because that's the main topic on most people's minds. But what about actually getting a mortgage right now? Are lenders being difficult and tightening their criteria like we sometimes see? Or are they actually interested in doing more business and making things a little easier again?
There's lots of liquidity in the market and lenders are eager to lend. They're coming up with different ways to make deals work from a pricing and stress testing point of view. However, there are some criteria points that are still being held back on, such as expats, for example. There are still a lot of lenders that used to be in the expat space that temporarily withdrew and haven't come back yet. Although, to be honest, this was happening during the early stages of COVID rather than recent events.
Well, we have a lot of expats listening, so let's hope that improves soon. So are there any particular lenders or products that investors should be keeping a lookout for at the moment?
I've got one or two lenders talking about launching a 5-year fixed rate with only a 2 or 3 year early repayment period, meaning you benefit from the favourable stress tests of a 5-year fixed without being tied in for the full 5 years. I'm really excited to see what these look like over the next couple of weeks, as I know a lot of investors would just like to have some flexibility in the next couple of years.
That sounds great. I'd definitely be a customer for one of those. So Kelly, you've shared so much and we're really grateful to you. Is there anything else that investors should be keeping in mind right now?
A bit of advice more than anything. If you're a new investor, be mindful of doing your due diligence before reserving a property. There are certain things that can cause your interest rate to rocket, such as first-time buyers, first-time landlords. There are hardly any lenders that consider this type of borrower, which drives the pricing up. Those lenders that can consider aren't the easiest to deal with, and they can cause delays, which we really can't afford, especially on a new build purchase with completion deadlines. Therefore, if you do fall into this category, please reach out to me beforehand and I can quote you terms on this basis and help manage your expectations. Also, I will always only present the most competitive option to my investors based on their circumstances. Even though arrangement fees are high on some products at the moment, and typically the top 3 lenders are at either 3 or 5%, they are still the most competitive lender when you compare the overall cost of borrowing over the fixed rate period. I know it's hard to get your head around, but I get a lot of kickback, and sometimes some investors still opt for the second best option because they have a lower fee and in their head that is cheaper. But because the rate is higher, they will actually be paying more over the term. Apart from that, in our world, it's business as usual. Don't be afraid to buy or refinance. And if you have any concerns, then please feel free to reach out to me and I'll be more than happy to have a chat through it all.
A huge thank you to Kelly Rule for bringing her incredible knowledge to the podcast. Let's face it, mortgages are a huge part of what we do as property investors, whether you're looking to get started, grow your portfolio, or just maintain it with refinancing. So that information is so valuable. So a huge thank you to Kelly. Rob, what I liked most about the stuff that Kelly was saying is it more or less backs up everything we've been saying for the last few weeks. But in all seriousness, it is pleasing to see that the rates are coming down as the media's been reporting and we've been reporting on the podcast, and things are getting better and things are picking back up.
Definitely. And it seems like you've got a landscape where lenders actually want to lend. And that's important because we've seen times in the past when big events have happened when that's not the case. And now, obviously, with the base rate increasing as much as it has and no one knowing quite where it's going to end up, that makes it more difficult for them to set their rates. But they do fundamentally actually want to do business, which really helps. And it's a good sign for the future. I think, Rob, that Kelly made a really important point at the end when she was talking about fees, because I've noticed as well, we've mentioned it on the podcast once or twice, that rates are coming down, but arrangement fees in many cases have been going up, and it can look pretty off-putting. And in some cases, they are off-putting and it fundamentally changes the deal. But the critical thing is to take all your interest costs and all your fees combined and figure out what that would cost you over the life of the mortgage to work out what the best product is. And that's why using a broker, whether it's Kelly or anyone else, is so important, because it's not the easiest thing to work out. And because there are brokers, it's just not something you have to spend your time on.
No, and at the moment, I mean, we said earlier on the podcast, things are changing week by week, but I think Kelly's highlighted that it's day by day at the moment. It's a really intense period in the world of mortgages. And luckily, things are getting better, as you've heard, and really are improving. And that is brilliant for us all to hear. But as you said, Rob, it's not as simple as just looking at a web page, picking a product and getting your mortgage sorted. So do use a mortgage broker. We always do. If you want Kelly's details, they'll be in our show notes. But once again, a huge thank you to Kelly. We will definitely have her back on the show in the not too distant future, because these episodes are always super popular and we want to keep you updated.
Okay, let's move on to Hub Extra now, part of the show where we like to end by giving you something a little bit more. And I've got something random this week, because it's to do with health and fitness, and in particular, tracking your weight. They can debate whether that's a sensible or worthwhile or healthy thing to do or whatever, but whether you're looking to lose weight or gain weight, I learned something over the last couple of months that's really helped me out. I didn't invent it, but if I was hearing it for the first time recently, chances are someone else will be hearing it for the first time too. And the thing is, when you are tracking, you can have huge variations from day to day for a whole number of unrelated reasons. So if you're looking at a number daily, you could feel really good or really bad about it, but actually it's just completely random. And if you're only measuring once a week or once every couple of weeks, again, you could get a random measurement for other factors. So what I've been doing is taking a measurement every day, but paying no attention to that measurement at all, but feeding it into a 7-day average and paying attention to that. Really easy to do on a spreadsheet. And I'm sure there are apps that do it for you as well. But that way, you've got loads of data points, all the outliers to the high side or the low side even each other out, and you can track the average to see if things are moving in the right direction for you or not. You could probably apply the same principle to tracking other things as well, like your finances or whatever. But just for that kind of measurement, it's a tiny thing, but I found it really helpful, so I thought I'd share.
I like that, Rob. And I can help you take it a step further if you don't want to be manually putting into a spreadsheet. If you get one of those fancy scales that connect to an app, it will update Apple as well, on Apple Health, and then Apple Health will calculate your average for you. So I've just gone on my phone now and checked out my average for the last 6 months. I'm not going to give you the number, but I've got it here. So you can have that automated for you as well. But what I wasn't doing is ever looking at that number. So I think that's really interesting to do. But those fancy scales aren't fancy prices. You can get them for under 50 quid, probably under 30 quid on Amazon. I don't think mine was particularly expensive. They do loads of measurements and they often come with an app, and you can connect them to Apple Health as well, which if you've not looked at Apple Health recently, do go and have a look, particularly if you've got an Apple Watch, because there's loads and loads of data in there. It's really, really interesting. Yeah,
I was looking at that, but then I had to turn it off because it kept nagging me and I didn't want to be nagged. But that says more about me than the technology. The technology itself is really good. So that is us done for this week. Thank you so much to Kelly, and thank you so much to you for listening. If you've got thoughts to share, we'd love to hear from you. We're on all the socials at Property Hub UK. There's also, of course, our YouTube channel, where we're on a particularly strong run at the moment, doing some good stuff on YouTube. So do just search for Property Hub on YouTube. But most of all, make sure you join us back here next Thursday for what's going to be a very special episode. So have a great week, and we'll see you then. Bye-bye.
Bye-bye.